In this video, we're going to compare the traditional income statement to the contribution margin income statement. If you've taken accounting or if you've looked at a company's financials, you've seen a traditional income statement. You've got sales revenue at the top, followed by cost of sales and gross margin, followed by operating expenses and operating margin, followed by non-operating items, income tax expense, and finally, net income. But if we dive deeper, you'll see that the costs are actually organized by function. Cost of sales is the cost of producing or purchasing inventory. Research and development is the cost of developing new products. Selling or marketing expense is the cost of sales commissions and advertising. And administrative expense includes executive salaries and other corporate level costs. This functional classification of costs is helpful for external parties. Investors and creditors can assess a company's ability to manage its costs and improve operations. They do this by evaluating the company's performance over time to see if margins are improving, and by benchmarking the company's performance against that of its competition by comparing margins. This is all helpful. However, the traditional income statement has a glaring weakness. It doesn't allow a company to perform cost volume profit analysis. CVP analysis is very important for a company's managers. They need to know how many units the company needs to sell to break even, or what sales level the company needs to reach in order to achieve a certain profit, or how profit would change for a given change in sales. Managers might also wonder how much sales could fall before the company starts losing money. And you can't answer these questions with a traditional income statement. To perform CVP analysis, you need to know how costs behave, which costs are fixed, and which costs are variable. A traditional income statement makes no distinction between fixed and variable costs, but a contribution margin income statement does. The contribution margin income statement organizes costs based on their behavior. Here's an example. Note that fixed and variable costs are clearly identified. Whereas the traditional income statement lumps variable and fixed selling costs into a single line item, the contribution margin format separates selling costs into their fixed and variable components. And once you've isolated the total variable cost, you can calculate the contribution margin and the contribution margin ratio. Having this information makes it easy to perform cost volume profit analysis. You can calculate the degree of operating leverage, the break-even point in terms of sales dollars, and the margin of safety. So hopefully you now see how the contribution margin income statement differs from a traditional income statement. Both are helpful tools that you should be familiar with. But the traditional income statement is geared toward external reporting, whereas the contribution margin income statement is focused more on internal decision making, helping managers make better decisions.